Stop. Just stop what you're doing right now, because while you were sleeping last night, while America was celebrating the long weekend, Shanghai did something that Wall Street is desperately trying to hide from you. They drew a line in the sand at $86.70, a price floor so massive, so calculated, that it could trigger the largest short squeeze in crude oil history. But here's what they're not telling you. This isn't just about oil anymore. This is about a financial weapon, and the countdown has already begun. Welcome, my friends, to Currency Archive. You know, I always tell my father, a man of wisdom, over 70 years now, that the most valuable currency isn't money, it's truth. And if you value truth over propaganda, if you're tired of the lies mainstream media feeds you, do me a favor, press that subscribe button right now, like you'd save an important phone number you can't afford to lose. And tell me, where are you watching from today? New York? London? Dubai? Mumbai? Drop your city in the comments, because what I'm about to reveal affects every single one of you, no matter where you are. On the evening of February 14th, 2026, while most of the Western world was winding down for the weekend, something unusual happened in Shanghai. The trading screens at the Shanghai International Energy Exchange flickered with a pattern that seasoned traders had not seen in years. Crude oil futures contracts were being bought in massive volumes. But this was not ordinary buying. This was systematic. This was calculated. And most importantly, this was setting a floor. By the time the session closed, a line had been drawn at exactly $86.70 per barrel. To the casual observer, this number meant nothing. Just another price point in a volatile market. But to those who understand how commodity markets actually work, this was a declaration. Shanghai had just told the world, we will not let oil fall below this price. The timing was perfect. Within hours, the Shanghai Exchange would close for the Lunar New Year vacation. Trading would halt. The markets would go dark for days. And when they reopened, this floor would be set in stone, reinforced by hundreds of millions of dollars in physical buying. But here's what makes this moment different from every other market intervention in recent history. This was not about stabilizing a crashing market. Oil prices were not in free fall. There was no panic, no crisis, no emergency that demanded immediate action. This was strategic positioning. Shanghai was not reacting to market conditions. Shanghai was creating them. The Shanghai Crude Oil Futures contract, launched in 2018, was designed for one purpose: to challenge Western dominance over energy pricing. It was built to be different, unlike WTI and Brent, which are primarily paper markets where most contracts are settled in cash. Shanghai demands physical delivery, real barrels, real oil, real consequences for those who cannot deliver. For years, this contract operated quietly. Volume grew steadily. Chinese refiners began using it. Asian traders started paying attention, but it remained secondary, a regional alternative, nothing that threatened the established order. Until now. The $86.70 floor changes everything because it exposes a vulnerability that Western markets have been ignoring for years. Here is the vulnerability. Western oil futures markets are built on leverage. Traders can control massive positions with relatively small amounts of capital. This creates liquidity. This creates efficiency. But it also creates a dangerous imbalance between paper contracts and physical barrels. In simple terms, there are far more promises to deliver oil than there is actual oil available to deliver. Shanghai knows this. By establishing a price floor with physical buying, Shanghai is forcing a simple question. Can Western traders actually deliver oil at prices below $80.70? Or are they simply trading paper promises that cannot be fulfilled when someone demands real barrels? This is not theoretical. This is happening right now. Consider the mechanics. If Shanghai holds the floor at $86.70 through physical purchases, it creates a pricing anomaly. Western benchmarks might show lower prices on screens, but actual physical oil becomes difficult to source below Shanghai's floor. Refiners who need real barrels, not paper contracts, start looking east instead of west. This is how pricing power shifts, not through dramatic announcements, not through geopolitical threats, but through quiet, systematic accumulation of physical inventory backed by financial firepower that can outlast paper traders. The pre-vacation timing amplifies the impact. While Shanghai's exchange is closed, Western markets must operate without the reference point of active Shanghai trading. When Shanghai reopens, traders will discover whether the floor held, whether physical demand absorbed all offers below $86.70, whether the new price reality is permanent. History shows that major shifts in commodity pricing rarely announce themselves with fanfare. The 1973 oil crisis began with seemingly minor supply adjustments. The 2008 commodity supercycle started with unremarkable inventory data. The patterns are always visible in hindsight, but only those watching closely see them in real time. Shanghai just gave the market a real-time signal. The question is, who is paying attention? There's a warehouse in Zhoushan, China, that most energy traders have never heard of. It sits on a small island in the East China Sea, unremarkable from the outside. No logos, no signs indicating its importance. Just another industrial facility among thousands along China's coastline. But inside this warehouse and dozens like it scattered across eastern China sits something that is quietly rewriting the rules of global energy markets. Physical crude oil, millions of barrels, real, tangible, deliverable. This is the ammunition behind Shanghai's $86.70 floor. While Western financial markets have spent decades perfecting the art of trading paper contracts, Shanghai has been doing something different, something older, something that Wall Street forgot was important. They have been accumulating the actual commodity. To understand why this matters, one must understand how modern commodity trading actually works. In New York and London, when a trader buys an oil futures contract, they are almost never planning to take delivery of physical barrels. The contract is a financial instrument, a bet on price direction. When the contract expires, it is settled in cash. The trader receives or pays the difference between the contract price and the settlement price. No oil changes hands, no tankers are loaded, no storage is needed. This system is efficient. It creates tremendous liquidity. Billions of dollars can flow into and out of oil markets without a single barrel moving. Banks, hedge funds, pension funds, all can participate in energy markets without ever touching physical oil. But this efficiency comes with a hidden cost. When markets are built primarily on paper promises rather than physical delivery, the connection between financial prices and physical reality becomes elastic. It can stretch, it can bend, and under the right pressure, it can break. Shanghai designed its system differently from the beginning. The Shanghai International Energy Exchange requires delivery, not as an exception, not as a rare occurrence that traders try to avoid, but as the fundamental mechanism that gives the contract its legitimacy. Every contract traded in Shanghai is backed by the explicit understanding that physical oil must be available for delivery. The warehouses must have inventory. The inspection certificates must be valid. The logistics must be in place. This creates friction. It limits how much leverage traders can use. It prevents the kind of massive speculative positions that dominate Western markets. But it also creates something else. It creates pricing power based on physical control rather than financial firepower alone. Here is where the $86.70 floor becomes a weapon rather than just a price level. When Shanghai sets a floor through physical buying, they are not simply placing bids on a trading screen. They are instructing state-backed entities to purchase and store actual barrels of crude oil. These barrels go into warehouses. They become inventory. They create a physical backstop beneath the price. Now imagine you are a trader in New York who has sold oil futures contracts short, betting that prices will fall below $86.70. In a normal paper market, this is a reasonable trade. You watch supply and demand fundamentals. You calculate that oil should trade lower. You place your bet. If you are correct, you profit when the contract settles below your selling price. But what happens when someone is willing to buy unlimited physical barrels at $86.70? Suddenly, your paper bet faces a physical reality. If prices approach the floor, Shanghai does not just place bids. They take delivery. They pull barrels out of the global supply pool. They reduce the available inventory that other buyers need. This creates a squeeze. Physical refiners who need actual oil for their operations start competing for available supply. They cannot settle in cash. They need real barrels. If Shanghai is buying aggressively at $86.70, these refiners must bid higher to secure their supply. Meanwhile, the paper trader who sold short discovers that their bet is not against market fundamentals anymore. Their bet is against the financial reserves of the Chinese state and its willingness to continue physical buying. This is an unwinnable contest. The mechanics become clearer when examining the numbers behind Shanghai's infrastructure. Since 2018, China has expanded its strategic and commercial oil storage capacity to over 1 billion barrels. The exact figures are state secrets, but satellite imagery, shipping data, and customs records tell the story. China has built the physical infrastructure to absorb massive amounts of crude oil without straining its storage capacity. Compare this to the United States Strategic Petroleum Reserve, which was drawn down from 650 million barrels in 2021 to approximately 350 million barrels by early 2026. The reserve that once provided a cushion against supply disruptions has been depleted. The ammunition has been spent. Shanghai is filling while the West is draining. This asymmetry creates the foundation for a price floor to function as a financial weapon. Shanghai can sustain physical buying at $86.70 for months, potentially years, while accumulating strategic inventory. Western paper traders can sustain their short positions only as long as their margin requirements allow. When the Lunar New Year vacation ends and Shanghai's exchange reopens, the market will reveal whether the floor held. If it did, if physical buying absorbed all selling pressure below $86.70, then a new pricing regime has been established, one that the West cannot break through paper trading alone. There's a refinery manager in South Korea who woke up on February 15th to a problem that did not exist the day before. His company processes 400,000 barrels of crude oil every single day. The contracts for this oil were negotiated months ago. The prices were locked in based on Brent crude benchmarks. The financial models assumed stable correlations between Western and Eastern pricing. But overnight, those assumptions became obsolete. Now, this manager faces a choice: continue purchasing oil linked to Brent pricing and risk supply disruptions if physical barrels become scarce, or shift to Shanghai-linked contracts and accept the 86.70 floor that just increased his input costs by approximately $4 per barrel. Neither option is good. Both options are expensive, but one option guarantees supply. The other does not. This is the invisible redistribution of wealth that happens when pricing mechanisms shift. It does not appear in headlines. It does not trigger dramatic market crashes. It simply transfers billions of dollars from those caught on the wrong side of structural change to those who positioned early. The winners in this new landscape are easy to identify once the pattern is understood. First, the oil-producing nations that signed UN settlement agreements with China over the past 5 years: Russia, Iran, Venezuela, Saudi Arabia through selective contracts. These nations can now sell physical barrels at Shanghai's floor price, which is higher than what many Western contracts currently offer. The mathematics are straightforward. If a producer can sell oil at $86.70 in yuan through Shanghai, or $82 in dollars through traditional channels, the choice is obvious, especially when currency conversion costs and sanctions considerations are factored in. This creates a bifurcation in global oil flows. Physical barrels start moving east instead of west, not because of embargoes, not because of political decisions, simply because the economics favor Shanghai's pricing over Western benchmarks. Second, the commodity trading houses that built dual infrastructure years ago. The firms that established operations in both Singapore and Geneva, the traders who learned to navigate both NYMEX and INE contracts, the logistics companies that invested in yuan clearing capabilities before it became necessary. These entities now operate as bridges between two increasingly separate markets. They can arbitrage the price differences. They can source from producers selling below $86.70 in Western markets and deliver into Shanghai at the floor price. They can exploit the temporary inefficiencies that always emerge when established systems fragment. Third, the financial institutions that accumulated positions in Shanghai crude futures when Western traders dismissed the contract as irrelevant. The banks that built relationships with Chinese clearinghouses. The hedge funds that studied the physical delivery mechanisms and recognized their strategic importance. These early movers now hold positions that have gained value not through luck, but through understanding structural shifts before the broader market recognized them. But for every winner in this redistribution, there is a loser facing unexpected costs. The most exposed entities are those that built their business models on assumptions of continued Western pricing dominance. Airlines provide a clear example. Most major carriers hedge their fuel costs months or even years in advance. These hedges are based on established correlations between jet fuel prices and benchmark crude prices like WTI and Brent. But if physical crude becomes scarce at prices below 86.70, refiners must pay more for their input costs. Those higher costs get passed to jet fuel buyers. The airline's hedges, designed to protect against price increases, fail because they were calibrated to old pricing relationships. The airline finds itself paying spot market prices that are higher than their hedges anticipated, while still paying for the hedges themselves. Double exposure, double pain. Similarly, emerging market economies face a hidden tax they did not budget for. Countries like India, Turkey, or Brazil import massive quantities of crude oil. Their national budgets, their subsidy programs, their inflation calculations, all were built assuming oil prices in a certain range based on historical patterns. Shanghai's $86.70 floor effectively raises the minimum cost of their energy imports. This flows directly into inflation. It pressures their currencies. It forces difficult political choices about subsidies and price controls. The damage accumulates quietly. A few percentage points of additional cost across millions of barrels per day. Over months, this becomes billions of dollars in unexpected expenses. But perhaps the most significant consequences are the unintended ones that cascade through interconnected systems. Consider the impact on sovereign debt markets. When energy importing nations face higher oil costs, their trade deficits widen, their currencies weaken. The cost of servicing dollar-denominated debt increases. Credit ratings come under pressure. Bond yields rise to compensate for increased risk. Suddenly, a pricing floor in Shanghai's oil market becomes a stress test for government finances in countries that have no direct involvement in Chinese commodity exchanges. Or consider the impact on inflation expectations. Central banks in the West spent 2024 and 2025 fighting to bring inflation under control. Interest rates were raised, demand was suppressed, progress was being made. But if energy prices now have a floor at 86.70, If that floor is defended through physical buying that Western monetary policy cannot influence, then central banks face a new problem. They cannot control a component of inflation that is being set by forces outside their jurisdiction. Their policy tools become less effective. Their credibility suffers when inflation remains elevated despite restrictive monetary policy. There is a historical parallel worth noting. In 1973, when OPEC demonstrated its ability to control oil pricing through production quotas, the global economic order underwent a fundamental reorganization. The dollar's role as reserve currency was reinforced through the petrodollar system. Energy security became a central pillar of foreign policy. Financial markets developed entirely new instruments to manage energy price risk. That reorganization took years. The transition was painful. Those who adapted early thrived. Those who clung to old assumptions suffered. Shanghai's $86.70 floor may represent the beginning of a similar reorganization. Not a replacement of the old system overnight, but the emergence of a parallel structure that gradually draws liquidity, legitimacy, and market share away from established mechanisms. The question facing every business leader, every portfolio manager, every economic policymaker is simple. Do they recognize this shift while it is still early? Or do they wait until the costs of adaptation become unavoidable and far more expensive? There is a boardroom conversation happening right now in multinational corporations that has never happened before. The chief financial officer is presenting energy cost projections for the next fiscal year. The numbers look wrong. The hedging strategies that worked for the past decade no longer provide the protection they once did. The assumptions built into long-term contracts are colliding with a new reality that spreadsheets were not designed to capture. Someone asks the question that changes everything. What if Shanghai's floor holds? This is the moment when theoretical market analysis becomes operational urgency, because if the $86.70 floor is not a temporary aberration, if it represents a permanent shift in how energy markets function, then every business with significant energy exposure must recalibrate immediately. The first priority is understanding actual exposure. Most companies know their direct energy costs, the electricity bill, the fuel expenses, the natural gas consumption. These are visible line items in financial statements, but the hidden exposure is far larger. Consider a manufacturing company that produces consumer electronics. Their direct energy costs might represent only 5% of total expenses, but their suppliers use energy-intensive processes. Their logistics partners consume massive amounts of fuel. Their raw material costs are influenced by the energy required for extraction and processing. When energy prices rise due to a structural floor, the impact ripples through every layer of the supply chain. The manufacturer discovers that their true energy exposure is not 5%, it is closer to 30% when all indirect costs are included. The strategic response begins with mapping this complete exposure. Which suppliers are most vulnerable to higher energy costs? Which components have the highest embedded energy content? Which logistics routes are most dependent on fuel prices tied to benchmarks that may diverge from Shanghai's floor? This mapping exercise reveals where the actual risks hide. Once exposure is understood, the second priority is diversification of energy procurement. For decades, most Western companies operated with a simple assumption. Energy is a global commodity with relatively uniform pricing. A barrel of oil is a barrel of oil. The price differences between regions are small and temporary. Shanghai's floor breaks this assumption. Now, companies must consider operating in a world where energy markets are bifurcated, where Eastern and Western pricing can diverge significantly for extended periods, where physical availability matters as much as financial price. The operational implication is clear. Companies need optionality. This means developing relationships with suppliers who can source from multiple markets. It means building logistics flexibility to shift between Eastern and Western supply chains. It means creating internal systems that can track and compare pricing across different benchmarks in real time. A European automotive manufacturer provides a concrete example. Traditionally, they sourced components globally based purely on cost and quality. Energy prices were assumed to be similar everywhere. Now, they must evaluate whether components manufactured in Asia using Shanghai-priced energy have different cost trajectories than identical components manufactured in Europe using Brent-priced energy. They must build scenarios for what happens if the price gap widens. They must develop contingency plans for shifting production if one region becomes structurally more expensive. This is not about predicting which market will have lower prices. This is about maintaining the ability to adapt regardless of which scenario unfolds. The third priority is reassessing currency exposure. Energy and currency markets have always been connected, but Shanghai's floor strengthens this connection in a specific direction. If more physical oil trades at Shanghai prices, more transactions settle in yuan. Producers who sell to Chinese buyers accumulate yuan. Buyers who purchase from Shanghai-linked suppliers need yuan liquidity. This creates currency exposure that many companies are not prepared to manage. A Brazilian mining company that sells iron ore to Chinese steel mills already deals with yuan transactions. But if they now need to purchase Shanghai-priced oil for their operations, their yuan exposure doubles. They have both receivables and payables in a currency that most of their financial team has limited experience managing. The strategic response is not necessarily to eliminate this exposure. It is to manage it consciously rather than accidentally. This might mean maintaining yuan reserves to match yuan obligations. It might mean developing hedging strategies that account for energy currency correlations. It might mean working with banks that have deep expertise in multi-currency commodity transactions. The companies that adapt successfully will be those that treat this as a permanent shift rather than a temporary disruption. They will invest in building internal expertise. They will hire traders who understand both Western and Eastern commodity markets. They will develop relationships with brokers who can execute in Shanghai as easily as in New York or London. They will build systems that monitor multiple benchmarks simultaneously. They will create decision frameworks that account for physical delivery constraints, not just financial prices. Most importantly, they will recognize that the competitive advantage of the next decade will belong to organizations that can operate fluidly across increasingly separate market systems. There is also a defensive strategy that every energy-intensive business should implement immediately: aggressive efficiency improvements. When energy prices have a floor, when there's a limit to how low costs can go, the only sustainable way to reduce expenses is to use less energy per unit of output. This is not new technology. This is not revolutionary thinking. This is simple economics. But it becomes urgent when the downside protection that falling energy prices once provided is removed. If oil cannot fall below 86.70 because Shanghai will buy unlimited quantities at that price, then hoping for cheaper energy is not a strategy. Using energy more efficiently becomes the only reliable path to cost reduction. The final element of strategic response is scenario planning for further fragmentation. Shanghai's 86.70 floor may not be the end of this process. It may be the beginning. If this floor holds, if it successfully establishes a parallel pricing mechanism, what prevents the same approach from being applied to other commodities? Copper, aluminum, lithium, rare earth elements. Any commodity where China has significant consumption can potentially be subject to similar pricing strategies. Business leaders must begin modeling scenarios where global commodity markets are no longer unified, where prices in different regions can diverge significantly and persistently, where physical control matters more than financial size. This is not fear-mongering. This is prudent risk management. The transition away from unified global markets may unfold over years or even decades, but those who begin adapting now will face far lower costs than those who wait until the changes become undeniable. Shanghai drew a line at $86.70 before going on vacation. When trading resumes, the world will discover whether that line holds. But regardless of the immediate outcome, the signal has been sent. The era of Western pricing dominance in commodity markets is being challenged by an alternative system backed by physical buying power and strategic patience. Those who recognize this early will navigate the transition successfully. Those who dismiss it as temporary noise will face painful adaptation later. The choice is being made right now, in boardrooms, trading floors, and strategy sessions across the global economy.